welcome to the second part of this podcast. What I'm going to be looking at is the Auditors Report, the contents of the Audit Report. Okay, the first part of the Audit Report, and here I've got an Audit Report with just some comments around it. It's going to be is about the checking function. So what the auditors don't do, the auditors don't prepare the accounts, and I think that's a misconception a lot of people have, that, for example, KPMG, PricewaterhouseCoopers, Deloitte are preparing the accounts. They don't. They look at the accounts, they do certain checks on the accounts, and they then give an opinion on the accounts. And the opinions on their accounts they're going to give, we'll talk about true and fair in a moment, but they will give an opinion on the accounts in regarding to international financial reporting standards and whether the accounts actually meet those requirements, and the local accounts or the local regulations in the country in which the headquarters of the company are based, and whether the report meets those legal requirements. And they're going to give a report as well about whether the accounts are true and fair. And true basically means that everything reported in the account has happened. So, for example, they can prove that a particular transaction has occurred. And the other thing they're going to talk about is it's fair. And that means not only can you prove the transactions have happened, but can you prove it's being dealt with correctly in the account. They will look at how the accounts have been prepared, and a couple of key areas that they will look at is accounting estimates. So we're talking about things like depreciation. Are the depreciation charges realistic? If they've made a provision for a legal action that's going to be taken against the company, have they actually said that the likely loss is big enough? So, for example, a few years ago when BP had their oil spill in the Gulf of Mexico, the auditors would have commented on the size of the provisions put on one side by the business to cover those losses. And they'll also comment about whether the policies are appropriate to the group's circumstances. So have they, for example, allowed sufficient depreciation on their assets? If the price of a commodity has fallen and the main assets of the business are gold fields, silver fields, iron ore mines, does the value in the company accounts reflect the new circumstances? They'll talk about how the audit was conducted. So what have they actually done to check these companies' accounts? So what they're going to be looking at here is, first of all, they're going to look at the size of transactions. They're not going to go and check every single transaction that happened at Tesco's, which is a supermarket or salt centre if you're looking at this from the Middle East, because a single transaction isn't that significant. They will check some of those small transactions, but they won't check every one. But what they will do is go and check the large transactions completely. So, for example, this report here says that they're going to look at all transactions around about 150 million, because that's material in relation to this company. They'll comment on the fact that the company is a going concern, and the accounts also show that it's likely to be a going concern. And they'll also talk about the auditing techniques which they use. So what have they done to actually prove that these accounts have been done correctly? They'll also make a comment about who's responsible for what, and they're getting quite keen to do this now. So there will be information on directors' responsibilities and saying what the directors are responsible for, and the auditors will explain what they are responsible for, and they will make it very clear that they are responsible for their opinions. And at the moment they've got this little sort of caveat bit in here that only the shareholders of the company are really the people that are preparing the accounts for. I'm not so sure that's going to hold up in the long term, because in my opinion the original reason for doing accounts was also to help people who are creditors of the company, and I suspect that as creditors can actually access the accounts, at some point somebody may decide to try and take some sort of legal action in terms of that. Criticisms of auditing and how it works. First big criticism of auditing is that accountants often perform lucrative management consultancy work. So are they truly independent? that there's been several accounting scandals over the last sort of 10 to 20 years, one involving a company called Enron, where it was questionable whether the auditors were truly independent because other parts of the accounting firm were actually supplying a significant amount of management consultancy. The other problem is that the directors have the relationship with the auditing firm. So it's not the shareholders who actually talk to the auditors on a day-to-day basis. It's the directors. The directors really decide who's going to do the audit, and therefore the accountants may well be more influenced by their relationship with the directors and what they're doing for the shareholders. And also, they don't check every single transaction. So because of that, it's possible that the directors or the managers of the firm may direct them away from the areas of the company where they feel there are some problems. However, there isn't really an alternative. They are trusted by the tax authorities, and they're also overseen by all the main accounting bodies. And I suppose ultimately as well, in the final analysis, with more recent and more litigious actions being taken in places like the United States against audit firms, they've also got that fear that they may well get taken to court. Okay, other things as well that you can always talk about when you talk about the accounts, although this is a bit more sort of general, but there is a problem with the accounts that they're only looking at the historical aspect of the firm. So all the problems in the firm now that haven't been accounted for. It's still also a big summary. So there's no real detailed breakdown apart from the notes of the accounts of individual points. There's a lot of window dressing in the accounts still possible. So for example, revaluations going in, and a lot of the accounting policies, which are against depreciation, well, they're still things that are actually decided by the directors, and so long as it appears right to the auditors, they're not going to criticise it. Hope this helps with your revision, and hope you've enjoyed listening to the presentation. Bye-bye.